So hi everyone, this is Mayank, and today in this new lecture we are going to start with the chapter number 9, interest rate risk management. If you go through the section wise weightage, you will find that the chapter number 9 is forex and then international financial management, and the chapter number 11 is interest rate risk management. However, I feel that institute should have given this interest rate risk management chapter just after derivatives analysis and valuation, because whatever you are going to discuss in the interest rate risk management chapter is nothing but whatever we have already learned in the derivatives analysis and valuation. So half of the concepts will not be new to you. Okay, only the approach of those concepts, of the same concepts that you have learned, will be different in this chapter. Okay, so we are going to discuss most of the time forward, futures and options. Only 25% or 20% of the syllabus constitutes the interest rate swap concept that we are going to discuss at the end of the chapter. And now interest rate risk management, we are while doing the questions of forward, futures and options in this chapter, we will be dealing in a situation where we have a risk of interest rate, either falling interest rate or the rising interest rate. You need to understand what exactly is the interest rate risk first before moving into this chapter. But understand that whenever you discussed about the forward, futures, options in the derivatives chapter, the underlying asset was either stock, equity shares of any company, or index or commodity like rice, gold, etc. Okay, again you will be discussing about the currency derivatives, that means currency forward, futures and option in the forex chapter. So yes, the forward, future, option does not stop in this chapter itself. It is continued and it will be revised by you in this chapter and in this chapter. The only thing is, in these two chapters, these type of derivatives are more specific. Specific means all the derivatives in this chapter will be related to currency, and in this chapter it is related to interest rate risk. Understood? Okay, now coming over to the exam perspective, this is going to be a small chapter. It has only 34 questions first of all, but all the questions are, we can say, will require a good knowledge of effort, like good amount of effort and a knowledge as well. Okay, and from the exam perspective, it is going to come for 8 marks. As far as I can understand, one question of 8 marks can be asked from this chapter. Maximum theory of 4 marks can be asked. Okay, so you have to prepare yourself for that question, right? Good. Moving over to the index sheet, what type of questions we are going to solve, just have a look on this index sheet. The first 4 questions are based on the forward rate agreement. Out of that, 2 questions will be taken by us, and I think question number 2 and 3 will be given by me as homework because of the similar nature. Then we are going to start calculating the forward rate agreement, FRA. See, just a second. Yeah. So in the 4 questions, you are going to use the forward rate agreement already given in the question. But how to calculate that? That is the actual market price of FRA, which will be given in the first 4 questions. But whether it is correct or not, that will be decided by calculating the theoretical FRA, which we are going to discuss from question number 5. Okay, so question number 5, 6, 7, 8, 9, 10, you can see all depends upon the theoretical FRA. Once we calculate the theoretical FRA, we are going to compare that with the actual FRA and find out whether there is any arbitrage opportunity in the market or not. Arbitrage opportunity exists when the theoretical market price does not matches with the, is not equal to the actual market price. When theoretical market price is not equal to actual market price. If the actual market price is lower, we will buy FRA. If it is higher, we will sell FRA. Well, we are going to discuss that. Okay. So till question number 11, I think it is all about the theoretical FRA. And from question number 1 to 11, this is all about the forward contracts. You understand the meaning. FRA the full form of the FRA starts with the forward. This is all the forward contract. It's just like the forward contract you have discussed in the derivatives chapter. So there are almost, we can say, 11 questions on the forward contract, that is forward rate agreement. The forward contract in the derivatives chapter is called as the forward rate agreement in the interest rate risk management chapter. And just after that, we are going to start with interest rate futures. This is going to be interest rate futures. Okay, so question number 12 will be on the FRA and interest rate futures again, FRA and interest rate futures again. Then 14, 15, 16, you can clearly see it is all on interest rate futures. So we'll discuss that as well. This is going to be little difficult part to understand. We will focus on the concepts. Then some other question like swapping housing loan. This is the last concept that we are going to discuss. Then arbitrage with IRF. IRF means interest rate futures. And in the interest rate future itself, we are going to learn couple of concepts like cheapest to deliver bond, CTD bond. This is called a CTD bond. So what is exactly CTD bond? So till question 21, from question 12 to 21, that is around 10 questions will be based on mostly futures. First 11 questions were on are on theoretical forward contract. So 11 questions on the forward contract, almost 10 question if I skip this one, swapping, are on futures. And then we can see that option contracts is starting. In the derivatives chapter, we had two types of options. Call and put. And in this chapter, IRRM, we have two types of option, that's cap and floor. So call option can be very much related, like relatable to the cap option, and the floor option can also be connected with the put option. So you'll have a good idea of what's going on. Then after question number 26, we are going to start with question with the concept of interest rate swap, and it will go till the end. So around 8 questions, 25% of the syllabus of this chapter is on interest rate swap. Good. With this 8 questions, we are going to complete the one question that we actually postponed in the previous chapter. That's the last question it was in the previous chapter. So this is all about, sir, interest rate risk management. Before starting the concept and all that, I wanted to give you some clarity with which I think you are more comfortable now to discuss about all this interest rate risk management, because most of the concepts you can see, forward, futures and options, have been already completed by us. And now you can clearly understand that why I was saying this chapter should be started just after derivatives analysis and valuation, because it is the extension of the same. Okay, sir. Again, before moving over to the concepts, it's very important to understand the meaning of interest rate risk. Yeah. So this is interesting. You know why I keep on writing the topic name or the chapter name in bold and this much? Because when I'm going to just scroll through the PDF, it should be very easily visible that where the particular concept is starting. Although we should have followed this concept from the very beginning, but we did not do that. But that's all absolutely fine. I think whenever you realize, it's better. See, if we would have followed it from the very beginning, now there would have been like it would have been very easy for you also to scroll the entire PDF, because this is now 236 pages already, and I think this is going to go till 300 to 350 pages by the end of the syllabus. So this is interest rate risk management, sir, and now let's discuss about the concept of interest rate risk. Be comfortable and give yourself a little time to understand before moving over to the practical questions. Now this is a timeline. If you remember in the derivatives chapter, this timeline thing has helped us a lot to understand what exactly is happening and where, at which point. So let's say we are starting today, okay, and we need loan. We need loan. So there are two things that we will be talking about. One situation where we might need money, so we will be asking for the borrowings. Taking a loan from the bank is nothing but borrowings, a situation to borrow, okay, or loan, investing, borrowing, long, okay. So there are few terms I think that we should write it down first before all this. Take loan, another one is give loan. Taking a loan itself means we want to borrow money, borrowings. This means that we are investing somewhere. If we give loan to someone else, that means we are investing. The other person is the borrower in that case. And in case of borrowings, we use the word long, and this will be short. I will tell you. So long and short word will be used for the loan. So if you are buying the loan, you are into borrowings. If you are selling the loan, understand, if you are selling the loan, you are into investing. Okay. Now tell me one thing. In this case, you will be called as a borrower, right? And in this case, you will be called as an investor or depositor, we can say investor. Now, for the borrower, what is most important while borrowing the money from the bank or from any other institution? The most important part is the interest rate. Why? Because interest rate is going to be an expense for taking money or borrowing money from any institution. Nobody is going to give this money for free to us, right? And the cost to borrow the money or cost of this borrowing will be called as interest rate. And this is the most important part for us. We are going to analyze what exactly is being charged by the other institute for giving us the money. Most of the time in the entire syllabus, we will be solving the question from this angle and not this angle. It's just like solving the call options but not the put option. It's just like going long and not the short. Most of the time in the derivatives chapter, we were on this side. It's easy to understand from this side, okay? So, the important part to the borrower or investor, whether you are buying money or selling money, or one more word that I can easily attach with this entire scenario is so this is called as buying money, selling money. buying loan or selling loan. Okay, now just guide me through this. Am I right if I say the most important part for the borrower and the investor is the interest rate? Yes, sir. Interest rate matters a lot to the borrower and investor. Now tell me, once you borrow at a particular rate, what do you want the interest rate to go in the market? Where do you want the interest rate to go in the market? Do you want the interest rate to go up or down? Okay, before that also, understand there are two types of rates. One is called as the fixed interest rate and the other one is called as the floating interest rate. Now what happens in case of a fixed interest rate is, if you borrow or invest money at a particular rate, so let's say the rates are 5%, 10%, 15%, 20%, okay, and this is time 1, 2, 3, 4 years, and let's say if you borrow at a fixed rate, it is fixed for the entire tenure of your borrowings. So whether you borrow or invest for let's say 4 years, and if you are doing it at fixed rate, that means the rate will be fixed at 10% for all the 4 year. But what happens in the case of floating interest rate, and most of the time floating interest rate will be issued in the market. That means you will be borrowing money at floating rate or selling or investing money at floating rate. Now, if the rates are floating, that means it will keep on changing from time to time. So, even if you are borrowing at 10%, the same rate that was fixed earlier, but it will keep on changing every year. So, sometimes it will go up and then down as well. So, this is called as the floating interest rate. Floating interest rate keeps on changing from time to time, and the fixed interest rate is fixed for a particular contract. Okay, so we are good with it. Now understand that you are the borrower and the investor of a floating interest rate. So if you are borrowing money, borrowing it at a floating rate. If you are investing money, investing it at a floating rate. Now tell me, interest rate to the borrower, this is where the risk part is coming into the picture. Don't you think, let's say for example you are the borrower and you have borrowed money at 10%, and after 2 years, after let's say 1 year, it goes up to 13%. It's a good news for the borrower or the bad news? It's a bad news, sir, because when he borrowed money at 10%, he had to pay only 10% on let's say 100 lakh rupees of the borrowings. So at time 0, he paid 100 multiplied by 10%, that's 10 lakhs. But after a year, if the rate goes to 13%, he will be paying the same on 100 lakhs. So that will be 13 lakhs rupees for the second year, right? Who wants his interest cost to increase if the principal amount is same? All the borrowers in this world would want the interest rate to go down and down and down and down. So when the interest rate goes down after borrowing at a floating rate, it's a good news for them. They can save the interest cost on their loan. So the risk is not on the downside. The risk to the borrower is of rise in the interest rate, because the moment because every time the interest rate rises, the cost to the borrower on the same amount of money that he has borrowed also rises, and nobody wants to pay more. So the risk to the interest rate is the risk to the borrower is rise in the interest rate. So borrower wants the interest rate to go down, right? But the risk to the borrower is that it will rise. So borrower wants the interest rate to fall, okay, so that the cost can be reduced, but the risk to the borrower is, the risk means a situation where where loss can happen. Again, in another word, a situation of loss, we can say. So the risk to the borrower regarding interest rate is, it will rise, and if it rises, he will have to pay more, and he doesn't want the interest rate to rise in the coming future. And if he doesn't want that, he will have to take some action today itself. See how slowly we are coming over to the point. So my question to you guys are, is there any way to protect or avoid this risk? Question is, how to avoid this risk? Avoiding the risk means hedging. This is called as hedging interest rate risk. Now you tell me, borrower might take loan in the coming time, or he already have a loan in his account, and the risk to the borrower is that interest rate will rise in the future and he will end up paying more interest. That's why he wants to avoid the risk. That means he wants to hedge his position, or hedging against interest rate risk. He wants to hedge the interest rate risk. What are the options available? The very first option available to you is forward rate agreement. Let's first start discussion of this FRA. First of all, we will make sure that we know the full form of that, which is nothing but forward rate agreement, and understand the meaning itself. It means that you are entering into an agreement with a bank, mostly it will be a bank, where you are fixing the interest rate for a future date. That's why it is called as forward, where you are fixing the interest rate for a future date, where you are fixing the interest rate for a future date. That means at some time in future, you are going to buy the loan at this rate. So even if it goes up by the time you have to borrow loan, even if it goes up, this market rate goes up, still you will be able to buy the loan at this rate, because you had already fixed the rate with someone. So even if the spot rate goes up, you will be buying it at that fixed rate. Okay, so let me just explain that. Situation 1, we already have a loan, or I think we should first take it like this. We want to borrow loan, or we can say borrow or फिर buy loan after for 3 months. Now understand this logic. When do you want to borrow money? After 6 months from now. For how much period you want to borrow money? For 3 months. What happens is that when you buy the stock, you don't ask for how much period you want to buy the stock. It's like only when you buy the stock. But in case of loan, the period of loan also matters, not the timing only, but the period of loan also matters. So always we will be looking for two things in the question, that what is exactly the time of borrowing and for how much period we are borrowing. You can clearly see that we want to borrow or buy loan, that means borrowings, after 6 months from now, not today, but from today. After 6 months I will be borrowing the money, and at that time I will be borrowing it for 3 months. So logically speaking, the starting period of the loan is 6 months from now, and the ending period of the loan is 9 months from now. After 6 months, again 3 more months, that means 9 months from now. Starting period 6 months, ending period 9 months, and the borrowing period is the difference between 9 and 6, which is 3. So here is how we are going to present it. So this is a 6 months period, first 6 months and then 3 months. Okay. Understand. Let's say for example, the spot rate in the market today is 9%. So if you want to borrow money, you can borrow it today itself at 9%. But the fact is, you don't want to borrow money today. You need the money for your expansion of the business after 6 months only. Or maybe for purchasing some asset like plot, building, construction, anything, for purchasing the raw material. You need money after 6 months because you are planning to do all those activities after 6 months. Borrowing the money today and keeping it idle for 6 months is a worst financial decision, because you will be losing interest cost for this period. That will be a waste of money. So you don't want to borrow money today. That means this 9% is not for you. This 9% is not that important for you. What's more important is when I will go to the bank to borrow money after 6 months, there will be some interest rate. So one solution to that is, you can wait for 6 months and go to the bank. You will get to know the spot market, and at that rate you can borrow money. Exactly, that's what everyone does in the market. But there are some smart people in this world who knows that if the market interest rate goes up, if this interest rate of 9% rises by the time I need money, then I will be losing, or it will be a costlier loan for me. Let's take for example that he is expecting that the interest rate can rise to 9.6%. The expectation is 9.6%, and the fact is that today I can borrow money at 9%. After 6 months I think I will have to borrow money at 9.6%, and I don't want to pay that much of the interest. 0.60% on a amount, like if your loan amount is higher now, it's big now, then 0.60% also matters a lot. Let's take the loan amount first. We are just assuming that the loan amount is 60 crore. Now 9% on 60 crore is around 5.4 crore. 5.4 crore. And 9.6% on 60 crore is 5.76 crore. 5.76 minus 5.4, that's 36 lakh rupees extra you will be paying just because of the increase in the interest rate. Now this is what you are expecting. This interest rate is expected by you on this date. Okay, that if I wait till 6 months, I think the interest rate will go up to 9.60%. That's the risk to the borrower. Understand, the borrower has a risk of interest rate to rise. If the interest rate is expected to be Just a second. If the interest rate is expected to fall, if the interest rate expected by the borrower to fall, there is no interest rate risk, there is nothing to do or worry about, and there is nothing to learn about by us also in this chapter. We are learning where the risk is, where we can avoid the loss, that 36 lakh rupees of the loss. I think 36 lakhs is too much to pay for. Okay. So I am expecting at this point that the interest rate will go up, and that's the risk for a borrower, and I don't want to pay this much of the higher amount. I understand the market is going up, but 9.60% is too much to pay for. That's why what I can do is today I decide to go to the derivatives market. Do you think this guy is a speculator? No, sir. He is not a speculator. He already has a position in the spot market and he wants to protect his position. Protection from the rise in the interest rate. Protection from the high amount of interest that he is going to pay in the coming time. So he wants a protection. Speculator does not want any kind of a protection. He just plays on the prices. He just put a bet on the prices, and he doesn't have a position in the spot market. We have a position in the spot market. Position means we need to borrow loan in reality, na? So we will be taking a long position in the spot market in futures. So our position for the coming time in the spot market is long. Long means buy the money or borrow. Long means you are buying the money. The person who is taking the money is called as the borrower. The person who is giving the money is called as the investor. Okay, so today I will go to the derivatives market. This is where this chapter is starting now. I will be using the derivatives. I have learned a lot of concepts in the derivatives: forward, futures, options, and swaps. So let me just write down forward, forward. I need this space for other. So this is forward, futures, options, swaps, and for now we will be discussing this forward contract. So in the derivatives market means there is no specific place where this market is like opens every day and closes every day, right? This is just a contract. Now what exactly will happen in reality is you will go to the bank and you will ask the bank to enter into a forward rate agreement. A forward rate agreement. Now tell me one thing. If both the people, like you and the bank, enters into a forward rate agreement, who is the buyer of FRA and who is the seller of FRA? Who is going to go long on FRA? Who is going to go short on FRA? And it's very much easy to decide. Let me tell you one. For you, whatever you are going to do on this date, on the future date, whatever position you are going to take on the future date is the current position that you should take in the forward or any kind of a derivative. If you want to buy the asset on future date, buy FRA. If you want to sell the asset, sell FRA. Okay. In this case, we are going to buy money, long position. Long is what we are going to go on the borrowings or the amount of loan. Buy the loan, that means buy FRA. FRA, future, option, swap, all discusses the position that you want to take in these contract depends upon the position that in spot market you are going to take on the asset. Not today. Today's position, it should be exactly equal to today's position. If you have a long position in the spot market today, you should take short here because you want to do hedging. Long, short, long, short. So understand, every time, mostly you will be facing such situation, you will go long. So if you already have a short position today, go long in FRA. So this is opposite, but this is same. Why? Because these contract talks about future date, and whatever we want to do at a future rate, whether we want to buy the asset or sell the asset, the same position should be taken in the forward market as well. Okay. So we don't have any kind of a position today itself, right? Short or long, nothing. We just want to borrow money after 6 months. So summarizing the entire situation, we want to borrow or buy loan after 6 months for a period of 3 months. And the loan amount is 60 crore. Today's rate is, let's say, 9%. I am very much worried that after 6 months, since I want loan after 6 months, if I will wait and go and borrow the money, I will have to borrow it at 9.6%. I don't want to pay this much of the amount. And even if I have to borrow it at 9.6%, I should be like, if I'm paying higher interest in this case, I should be getting back that higher amount from the derivatives market. You remember the derivatives chapter? If in case the loss is confirmed, loss of 10,000 rupees is confirmed in the spot market, happens in the spot market, we were hedging through forward futures and option. Why? To compensate this loss for the profit of 10,000 from the derivatives market. So if you are paying higher interest, let's say a particular interest rate is there, and if you are paying more than what you desired, the same should be received back to you from the derivatives market, so that the net amount paid is less than this price. Okay, so let's start with this. Let's say both of you, the bank and you, agreed that the FRA rate should be 9.3%. You requested a lot to the bank to keep FRA rate at 9% itself, but the bank also is of the view that the market is going to go up, and keeping this rate for the future date is not desirable or is not profitable to the bank also. But the bank thinks that 9.30%, let's say for example, bank is thinking that the maximum the interest rate will go on this date is 9.2%. It is going to rise according to the bank also, but not this much. The bank is thinking that it might go maximum to 9.2%. Let's say the bank's perspective is 9.2%. Now, don't you think if the bank is thinking that 9.2% will be the rate after 6 months, it's better to sell a loan to the borrower at 9.3%, this 0.10%. Even if the rate rises to 9.2%, still the bank will have a profit of 0.10%. So bank is ready to sell FRA to you at 9.30%. Okay. Now you are also ready, because you think the market rate on after 6 months is 9.6, is going to go 9.60, and it's better to fix the rate at 9.30 instead of paying 9.60, right? Basically, this is going to be your cash outflow, and this is going to be a cash inflow to the bank. So instead of 9.20, if there is a 9.30 of the cash inflow to the bank is ready. Instead of 9.60 cash outflow, 9.30 is a cash outflow to you. You are also ready. Understand that the rate of FRA will be fixed somewhere in between the expectation of the bank and your expectation, like your expectation and the bank's expectation, so that it should look attractive to both of you while entering into a transaction. Obviously, on the future date, one of the party will lose the contract, because there will not be two rates on the same day. There will only be a single rate. Either your expectation will get fulfilled, either the interest rate will go according to your expectation or the bank's expectation. If it goes according to your expectation, bank will be like at loss. And if it goes according to bank's expectation, you will be at loss. Whatever it is. But for you, from your angle, this rate is quite good. Instead of waiting and paying 9.60%, it's good to fix the contract at 9.30%. Okay. Now, coming to the next step. You and the bank entered into a transaction where you fixed with the bank. You entered into a contract with the bank that after 6 months, for 3 months, you will take the loan from the bank. Take the loan, why? Long position. Because of the long position, you will take the loan from the bank at 9.30%, and whatever may be the spot rate on that date. So there is one benefit, that if the interest rate rises, you will still get the loan at 9.30%. But the problem will arise because of this contract. if the interest rate goes against your expectation, let's say if the interest rate goes down to 8.80%, at that time you will regret taking this forward rate agreement, because even though the rate is lower, 8.80%, still you have to pay for 9.30%. This is how the transaction will happen. There are few terms in this forward rate agreement which I think we should write first before moving ahead. This is an agreement, okay? You will be called as FRA buyer, or you are long on FRA. Bank on the other side will be called as FRA seller. You are short on the bank is short on FRA, okay? Type, this is okay, FRA rate first. FRA is fixed at 9.30%, which is an obligation, right? But the obligation as well to both. Then it's a type. What is the type of the FRA? It's 6/9 FRA. Now you need to understand how to read this. 6 has a meaning and 9 also has a meaning. 6 and 9. Loan period will, or we can say, let's continue with this. Loan period will start after 6 months from now, and the meaning of other parties so 9 means loan period will end after 6 months, after 9 months from now. So 6/9 FRA. 9 means loan period will end after 9 months from now, and 6 means loan period will start after 6 months from now. So this is how you have to read. Also, this particular thing is called as buy. You have to read it as buy. Okay. 6/9 FRA. This is the type. What else? Okay, one more thing. 0 time when FRA starts. This agreement is starting, and 6 months time when FRA ends. Okay. I can show that to you in the diagram as well. This is 0, 6, 9. On this date FRA starts. On this date FRA ends and loan period starts. And on this date loan period will end. Simple meaning. Okay. Now coming back to this position. So you have borrowed or you have a long position in FRA, that means you have promised the bank that you are going to buy loan or take the loan after 6 months for 3 months at 9.30%. Okay. Do you have to pay anything? Nothing to be paid today. There are sometimes upfront premium, but in futures there will be initial margin, in option there will be premium, but in forward and swaps there is just an agreement which happens between the two parties and nothing else. And then you will wait for the 6 months. What is going to happen after 6 months? What is going to happen after 6 months? Are you going to take the loan from the bank? Loan from the bank at 9.30%? No, sir. If you really want to buy or sell any kind of asset, whether it is loan, equity share, index, commodity, currency, anything, you have to do that in the spot market itself. That's what the reality is. Whatever you promise today, it will only be settled after the period or the FRA ends. FRA is starting at this date and it will end on this date. On this date, the cash settlement will happen. Whatever the interest rates are in the market, the bank will calculate the profit or loss, and if it's a profit to you, it will pay you, and if it's a loss to you, it will collect from you. That's what happens between in the FRA. Now, understand, your FRA was 9.30%. When the market, let's say for example, the spot rates on that date, the real rate, the spot rate on that date, we have waited for 6 months and now we are standing it at this date, and the actual rate on that date is 9.60%. Now you will be very thankful to your own decision that today when the market is buying loan at 9.60%, you can buy the loan at 9.30%. Obviously the cash settlement will happen, you will have to borrow in reality at 9.60, but the balance will be given back to you. The difference of this is your profit, because you are buying the loan at 9.30% when the market is buying it at 9.60%. It's a lower price to you, it's a profit to you. So FRA will get settled and the gain to you will be 0.30%. This is going to be a gain to you, right? Now, the next point. If in case the market rate goes to 8.80%, you will regret taking this decision 6 months back, because if you wouldn't have taken a loan or taken FRA at that date, you would have taken a loan at 8.80%. Now the bank will say that we had agreed at 9.30% and you will have to give us the difference amount. So in this case, this is a loss to you. Why? I will tell you once again. When the entire market or the public in the market is taking a loan at 8.80% spot rate, you have to take it. This is an obligation. You have to take it at 9.30%. So in this situation, you are paying more loan, more interest. 9.30 minus 8.80, that's 0.50 loss. This is a loss of 0.50%, and this is how you calculate the gain or loss. If the market rate goes according to your expectation, it rises, there will be a profit to you in the FRA settlement. And if the market goes against you, there will be a loss to you in the FRA settlement. And what about the loans, sir? 60 crore rupees. Who is going to pay us the 60 crore rupees? The bank will pay you 60 crore rupees in the spot market. So just go and buy in the spot market at 9.60%. Sir, but we never wanted to pay this much of the interest. Exactly. You have to buy it at 9.60, but the difference will be given back to you by the other party in the FRA. So this is your gain, this is your outflow, this is your inflow. This is your outflow, this is your inflow. The total is 9.30 itself. This is outflow, this is inflow. 9.30 will be the net. But in this case, this is going to be your outflow and this is also going to be your outflow because this is a loss. So 8.8 plus 0.50, 9.3. In both the cases, you have made sure that your interest rate will be 9.30% irrespective of the interest rate in the market. Do you understand this? FRA will always be settled in cash. So If we just look at FRA, the only cash inflow and outflow will be of this interest rate 0.30%, 0.50% applicable on the principal amount. We can say that there are some speculators in the market whose purpose will not be to do anything in the spot market or to take the loan or sell the loan. They will just enter the derivatives market, buy FRA at 9.30%, sell FRA at this rate, gain from it, and just go to home. And for them, this 60 crore will be a notional principal amount, not a real principal amount, a notional principal figure. Obviously, if there is a loss, you will have to pay 60 crore into 0.50%. That's the speculator is ready to take the loss, right? Ready to take the loss because of this possible gain. So yes, this market in this way can be used by a hedger in the first case that we explained the entire contract, can only be used by the speculator as well, and can be used by the arbitrator also if he thinks that he can buy FRA in this market and sell the money in this market, or take the loan from the spot market and sell FRA in the derivatives market. At expiry, he will make sure that he will only have gain. Yeah, that happens. Now let's focus on the hedging purpose itself. First of all, only hedging. So what is going to happen after 6 months? 0.30% is gain to you, 0.50% is loss to you. Whosoever is bearing the loss will have to pay it to the bank. So bank will pay you in this case, you will pay to the bank in this case. Now one thing that you should understand is 9% when quoted was per annum rate. 9.60% is per annum rate. 8.80% is per annum rate. 9.30% is per annum rate. All the rates when quoted, whether it is in spot market or the derivatives market, it was a per annum rate, and the loan period is only for 3 months. So in any case, you would not have paid the entire 9.60% interest on 60 crore, right? You would have paid only 3 months interest on that. If the net payable is also for 3 months, this is also for 3 months, can I say that the gain will also be for 3 months? Right. If 9.60% is a per annum rate, 9.30% is a per annum rate, can I say that 0.30% is also per annum gain? So this gain and loss is nothing but a per annum gain and loss. But my loan period is only for 3 months. I am taking a loan only for 3 months. So the gain should also be distributed only for 3 months. The loss should also be recovered only for 3 months. So can I say that 0.30 divided by 12 into 3, that means 0.0075% and 0.0125% is the gain or loss for 3 months. On which rate or amount it is applicable? It is applicable on 60 crore because 9.60 was all applicable on 60. 9.30% was also applicable on 60. So this gain or loss will also be applicable on 60 crore. Let's calculate in terms of amount. 60 into 0.0075, that's 60 into 0.0075%, that's 4,50,000 rupees, and 60 into 0.0125%, 7,50,000 rupees. In terms of rupees, this much is what bank will pay you, this much is what you will pay to the bank. Do you understand this? Step by step. This was a per annum rate. The difference between the per annum rate gives you the per annum gain or loss. But your loan period was only for 3 months. So the gain or loss will also be calculated for 3 months. And this is applicable on 60 crore. So this comes 4,50,000 and 7,50,000 as a loss. Now the last step is the settlement of FRA. Do you think the bank will pay you 4,50,000? Yes, sir. Wrong. Sir, this is a gain to us, right? The bank has to pay 4,50,000. No. Do you think you have to pay 7,50,000 to the bank? Wrong. Why, sir? This is a loss to us. We should be paying it to the bank. No. Why? I will tell you. Let's say, for example, forget everything and you would have taken loan at this date on the spot rate. So the rate would have been 9.60%. Do you think the moment you take the loan, you will have to pay the interest? Do you think the moment you take the loan, the rate is the interest is payable on the same date? No, sir. This rate is payable. This interest is payable after the 3 months end, or in general case at the end of the year. But this loan period is only for 3 months. So consider this. This interest is payable at the end of the 3 year. FRA, this 9.3% is also payable at the end of the year. So don't you think that the gain is also payable to you at the end of the year? Yes, sir. The cash outflow or inflow is at the end of the year, means at the end of the 3 months. So yes, bank has to pay 4,50,000 to you, but they will pay you at this date. It becomes payable at the end of the 3 months. So I'm just putting a mark there. This entire cash flow will happen at this date. Should happen. In fact, not will, should. This is what the bank will pay you. This is what you will pay to the bank, but at the end of the 3 months. Now in reality, on this date itself, the FRA gets over. I just told you here, the FRA ends when the loan period starts, because the FRA party doesn't have to do anything in this period. So settlement will happen on this date itself. So the real cash flow of settlement will happen on this date itself. How come? It's very simple, sir. Whatever is payable or receivable by us after 3 months, discount that by the spot rate. Discount it by 3 months at the spot rate. Discount it at 3 months at the spot rate and make the settlement. That's it. The story is over. Since all the parties on this date knows the gain and loss, practically it becomes baseless to wait for the 3 months and then to settle the amount. We agree that this amount of 4,50,000 and 7,50,000 is to be settled at the end of the 3 months, but it is already known at the end of the 6 months, this zero time of the loan period, and that's why it becomes illogical or baseless to wait for. It does not have any sense to wait for 3 months and then settle this amount. Instead, both the parties will agree to close the contract by paying and receiving the present value of this gain or loss. So yes, this gain or loss will be discounted by 3 months. At which rate? The spot rate. This rate is not to be used at in discounting. This FRA rate will never be used in discounting, because this is a customized rate made only for you and the bank in this contract. But for the entire world, 9.60 or 8.80 is the rate. So spot rate will be used to discount the cash flows. Okay, let's discount it. See, in the case of discounting also, this is per annum rate and we have to discount it by 3 months itself, right? So can I write down discount how to do that? It's very simple. 1 plus 0.096 is the per annum rate divided by 4 for 3 months, and I will divide it by this. In this case, 1 plus 0.088 divided by 4. This is going to be the settlement amount. So 4,50,000, 0.096 divided by 4 plus 1, 1.024. 439,453. Okay. $733,855. So understand the chronology, sir. This is payable at the end of 3 months. This is payable or receivable at time 0, and it will be settled. So these are the final figures which will be settled between both the parties. Sir, how come it's a part of the hedging? Yes, it's hedging. I will tell you. For a speculator, he doesn't have to do anything. He don't have to do anything with this market rate. For a speculator is coming in the forward rate for profit and loss, and this will be the profit and loss to him. For a hedger, we will have to show there is no profit or no loss. It's very simple. He will take the loan he will take the loan on spot rate on that date. So this is going to be his cash outflow, 9.60%, and 0.30% is his cash inflow. What is the net amount? 9.6 minus 0.30, 9.30. So this was what agreed between us, and that's why the hedging is completed. If the rate goes to 8.80, this is a cash outflow to him. This is also a cash outflow to him. The total of these two is nothing but the 9.30. So in any case, you will not be paying more than 9.30%. Hence hedging. Hence we can say that we have hedged it, because in the beginning itself we have confirmed that this should be the maximum rate. Yes. So this is how it is going to happen. Now we have to create a formula. Do you understand the entire logic? Just in a summary, I will repeat the entire situation. We wanted to borrow money, but after 6 months, and that too for a period of 3 months, right? Today's spot rate was 9%. We thought that if we wait for 6 months and then take the loan from the spot market, the market rate can go to 9.60%. And that's too high for us to wait for and to pay for, right? So we wanted to hedge the situation. We had to borrow around 60 crores. We wanted to borrow around 60 crores after 6 months. So what we did is, we went to the derivatives market and entered into a forward rate agreement. We went long on FRA. We purchased FRA. We bought FRA from the bank. Why we took a long position? Because we wanted to take a long position in the spot market after 6 months. So whatever the position is expected after 6 months, take the same in the derivative market. So we took a long position, and in that we fixed that 9.30% will be the interest rate that will have to be paid by me, because I am the borrower in any case. So now I'm not worried about the spot rate after 6 months. It can go up, it can go down, it can go anywhere. My interest rate is fixed at 9.30%. This entire agreement is called as forward rate agreement. Understand the logic. In this agreement, I am the FRA buyer. I am long on FRA. Bank is the FRA seller. Bank is short on FRA. FRA rate was 9.30%, and it's an obligation to both the parties. That means one will have loss, one will have profit. Okay. This is a 6/9 FRA. What is 6 and 9? 6 is the time. See, loan period will start after 6 months from now. And 9 means the loan period will end after 9 months from now. The difference between the 9 and 6 is the loan period. The 9 minus 6 is 3 months. That is the loan period. And this cross sign is called as buy. Okay. So this was what FRA period starts. FRA starts at this date. FRA will end after 6 months, and the loan will start after 6 months. And after 9 months, the loan will also end. Okay. What happened is that actual interest rate was 9.60%. We had an agreement at 9.30% with the bank. So we are on a positive side that even if the market is buying the loan at 9.60%, we can take it at 9.30%. The FRA party will say that, okay, you go to the market and take the loan from the market. The difference amount will be paid by me to you, so that it will not cost you more than 9.30%. So this is a gain to me. But obviously 9.60 was also for per annum, 9.30 is also for per annum. So gain will also be for per annum in this case. Now, so what we did is we calculated the gain for 3 months, because our loan period was for 3 months. And then the amount came to 4,50,000. Obviously, then we realized that in any case, we would have paid the interest at the end of the 3 months. So the gain is also become payable or receivable at the end of the 3 months. But the fact is that this amount of 4,50,000, which is to be payable or receivable after 3 months, is known at the beginning itself. And that's why both the parties will always decide to settle the discounted value of both. It's not practically logical to settle the 4,50,000 on this date itself. When it's payable, on this date, why anyone would want to pay the same at this date? If you want the money, you can take the discounted cash flow of discounted value of that. So both the parties agree to discount it by 3 months at the spot rate, and then this is the amount which will be settled between both the parties. You will receive this much if the interest rate is 9.60%. You will have to pay this much if the interest rate is 8.80%. The story is over. Now the question is how to calculate this entire settlement amount with the help of the formula, right? You will have to understand the formula, create a formula with that. Okay. Let's derive it. So the amount was 439,453. 439,453. It was calculated. We are going just reverse. 4,50,000 divided by 1.0024. Am I right? It was discounted by us. 1.024, I think. Right. And understand 4,50,000 was nothing but 60 crore. 60 crore multiplied by 0.0075% divided by 1.024 was nothing but 1 plus 0.096 divided by 4 months. Number of compounding we can say, or it's better to write it this way: 0.0096, 0.096, not 00, yeah, into 4 by 12, sorry 3 by 12, because we wanted for 3 months only. Nice. Again 60 crore into, how did we calculate 0.0075? How did we calculate 0.0075? We converted the actual gain in 4 months. So it was nothing but 0.30 into 4 by 12, 3 by 12 divided by 1 plus 0.096 into 3 by 12. And the last step, 60 crore multiplied by, how did we calculate 0.30? It was nothing but the spot rate minus F forward rate. The spot rate minus forward rate into, we can say formula, to it was 0.096 0.0075 instead of percentage na. So this will also be percentage. Then this will be written in percentage like this: 9.60 minus 9.30 into 3 by 12 divided by 1 plus 0.096 into 3 by 12. Now replace everything with a formula. 60 crore will be called as a notional principal amount. Okay, let's call this figure. This is going to be notional. Why notional, sir? Because the use of the forward rate agreement can be done by any person: hedger, arbitrager, speculator. If hedger is doing, then that principal amount will not be a notional to him, because in any case he would be buying that loan. But in the derivatives market, if you skip the spot market and look just at the forward rate, this entire amount becomes a notional amount, which is never which will never change hands. So we'll call it as notional principal amount. Okay. Now 9.6%, either you can call it as a spot rate or you can call it as a reference rate. In this chapter we will call it as a reference rate, but understand this from the spot angle. So it will be we can say reference rate, and this 9.30 is nothing but forward rate. So we will call it as forward rate. Okay, multiplied by 3 is the month till maturity. Can I say it as how many months? Months till maturity or expiry, maturity of the loan. If it is given in days, it will be days till maturity, DTM. This will be MTM. And this is months in a year, right? This is again reference rate. This is again months in a year and months till maturity. So let's write down the formula. RR minus FR into months till maturity divided by months in a year divided by 1 plus reference rate into again months till maturity divided by months in a year. So this is your formula, simple and sober. In this case, in place of months till maturity and months in a year, if the question gives you a data in terms of days, you can write it as like this: days till maturity and days in a year. Do you understand that? So this is your formula. Let's write down once again. This is 60 crore. What was the reference rate? 0.096. And the forward rate 0.093. We converted that into 3 months because it was an annual rate, divided by 1 plus 0.096 into 3 by 12. This is how you have to find out. So this is going to be your main formula for the future calculation as well. But this comes with a logic and you don't have to understand or mug up this formula. Come to the question now. This is question number 1 on the forward rate agreement. You can understand this formula. This is that 60 crore rupees notional principal amount. This is the spot rate on that date called as reference rate. This is the forward rate agreed between the parties at the very beginning itself. Okay. And days till maturity. This is days till maturity. And dy is the days in a year. Reference rate DTM dy. That's it. If you take into days, it will be like this. So this is your formula. Now understand the meaning of it. You can see the difference between the reference rate and the forward rate is the gain or loss to you, which is applicable on the notional principal amount, right? But this becomes per annum gain or loss, which has to be converted into the days till maturity or months till maturity. Now the entire numerator is become payable at the end of the loan period. That means 9 months. And that's why the settlement will happen at the end of the 6 months. That means the start of the loan period and the end of the forward rate agreement. And that's why we need to discount it. So the entire denominator is, the purpose of the entire denominator is discounting the profit or loss till the settlement period. From future till the settlement period. That's it. This was the same question. 60 crore, 9%, 3 months, 9.3% FRA, 8.8 or 9.6%, 2%, 2 different probabilities. What will be the effect of FRA and actual rate of interest cost to the company? See, in this question, they are not asking you to find out the profit or loss, but they are saying what is the effect of FRA, that is your profit or loss, and the actual rate of interest cost to the company, it will always be 9.30%. I will show you how. because this is a question of hedging. The person is going to buy the loan from the market and he will pay 9.60% per annum and he will receive 0.30%. So actual rate of interest cost is 9.30% itself. And in this case, he will pay 8.80% and he will also pay 0.50%. So the actual rate will be 9.30% itself. So it is fixed, right? See, 439, 453. Is it matching with our answer? $439,453. The second answer is 733,855. 733,855. Okay, this is the impact and the actual rate of interest cost. See, this is how you have to present in the exam. When they say actual rate of interest cost, you need to make sure that you are calculating the interest cost in both the markets. So I told you that one will be this 9.6 and the one will be the gain. Or in another way, I can okay, it's given itself. So in the spot market, I will just show you. From this point to this point, the transactions or the cash flows will happen in the spot market. From this to this, it is going to be the settlement of FRA market, and this is going to be the total to you. So whatever the cash flows you are doing in the spot market will be the actual interest you will be paying for borrowing 60 crore. That is 1 crore 44 lakh and 1 crore 32 lakhs. Understand that in both the markets, whether it is a 9.6% rate or 8.8% rate, you are borrowing money. Both will be your cash outflow because you have to pay interest for 3 months. Okay. But in FRA market, there will be some cash inflow if there is a gain or cash outflow if there is a loss, which is nothing but 4,50,000 and 7,50,000, right? Both of which is payable at the end of 3 months. And this is the cost to you, the total cost. 1 crore 39 lakh 50,000. When you divide 1 crore 39 lakh 50,000, which is the total of 144 and 450, it is 60 crore, by 60 crore. And then this is for 3 months, convert the 3 months into per annum, the rate will come to 9.30% automatically, which was the same rate which was agreed by you at the beginning, that the interest cost to you should not be more than 9.30%. It's 9.30%. So this is how you have to present the entire question. I hope you understood it. This is going to be your homework because it is more or less the same. And we will shift to the question number 3. Acha, question number 3 is also same, but let me just take it quickly. The loan period in this case is $15 million. Okay. Right. Understand. The treasurer of a company expects to receive a cash inflow. We don't want loan in this case. We will be receiving the surplus amount, this cash inflow of $15 million in 90 days. The treasurer expects a short-term interest rate to fall. The risk is to fall. Now, let's have a look on the other part of the game. We started with this thing, right, entirely, but when after a moment we shifted to single side, that is the loan side. Now let's talk from the angle of the investor. If he's selling money, giving loan, investing, going short, or investor, all and all are the same. That means we are putting money somewhere. Okay. What is the what we expects the interest rate to? Write down. Expects the interest rate to fall. In this case, we expect the interest rate to rise. A person who is investing in the market would anytime want that his investment should grow. So the interest rate has to rise in future so that our investment grows. So this is not a risk to the investor. Rising interest rate was a risk to the borrower. But for us, for the investor, rising interest rate is a good news. So what is the risk of interest rate to the investor? That it will fall. And if it falls, understand, if it falls, this is a situation of a loss And how to avoid the falling interest rate? Go and hedge with the interest rate risk in FRA. So the entire picture will be repeated from this point. Okay. So we will take the FRA. Now understand. Question number 3. This was all the discussion that we did was on question number 1. Do you understand that? Now question number 3. So the question says that in 90 days we are going to receive 15 million euros. So this is 0, this is 90 days. We will receive 15 million euros in the spot market. Right? Okay. And in order, see, we are expecting today's rate. Let me just complete. The treasurer decides to use more details are not given in this question. So whatever is the spot rate today, I think it's not given in the question. After 90 days, if I'm going to receive this much of the amount, what I will do with that is I will invest it somewhere. But the main problem with me is that I think the interest rate today, whatever it is going to fall. If I can invest it today, it's good. But I am not getting the money. I am not receiving the money today. I will be receiving it after 90 days when I am expecting that the interest rate would have gone down. And that's why I want to do hedging. Okay, hedging with the FRA. The question is whether you will buy FRA or sell FRA, whether you will go long or short. And it's very simple, sir. In the previous question, we were borrower, not the investor, and we wanted to borrow after 60 days. We wanted to buy money after 60 days. That means it would have been a long position for us. See, long means borrowing money, short means giving money, selling. So in this case also, after 90 days, we will receive the money and we will invest it somewhere. So we want to sell money after 90 days. After 90 days, we will create a short position in the spot market. And that's why in order to hedge, create a short position in FRA today. Sell FRA today to someone who needs money. Pay that money to someone, like in the contract. So if you are selling FRA today, let's say for a particular rate, and the interest rate goes down, it will be a profit to you because you sold at that rate. Now, in order to hedge against the risk, the treasurer decides to use FRA, which will expire in 90 days. That means it will start here and the FRA will expire here. It has to expire on the same day we want to take a position in the spot market. Okay, sir. Then and is based on the 90-day LIBOR. Acha, what is LIBOR? LIBOR is nothing but London Interbank Offered Rate. So L for London, I for Inter, B for Bank, O for Offered, R for Rate. So what happens in the London is that London means UK, is that a set of banks on a daily basis, the community on a daily basis releases this rate, and it's applicable and used by the entire financial, like all over the world, by lots of financial institution as a basis, unbiased basis. So this is a kind of a floating rate, you can say, floating rate, because it is different every day. So every day between 11 to 1 o'clock, I think on Indian Standard Time, this rate is declared by the group of those bank. Now I think this LIBOR has been demolished, like abolished or something. I heard the news in few months back, but I don't know yet. Okay, let it be, doesn't matter. The FRA is quoted at 1.5%. So the rate that was agreed is 1.5%. So if you are selling FRA, that means you will receive this much of the interest, and that's fixed. If the market goes down, still you will receive this much of the interest. If the market goes up, you will be at a loss. because if the market is going 2%, so instead of investing at 2%, you will be getting only 1.5%. That's the loss to us. Doesn't matter. At expiration, LIBOR is 1.25%. See, what happened in reality is the spot rate on that date was 1.25%. What does that mean? It means that if you would not have taken or hedged yourself in the FRA, you would have invested this 15 million euros or dollar, I think, dollars at 1.25 rate, right? It's good that you sold FRA in the beginning and fixed your rate at 1.5%. What will happen because of that is, in reality, after 90 days, you will invest $15 million at 1.25 rate itself in the market, but you will also get the difference amount from the FRA. So the gain in FRA will be 0.25% per annum. This is going to be your gain. So ultimately, you will get 1.5%. 1.25 from the spot market by investing this real amount, and 0.25% from the FRA market on the notional principal amount. So for FRA, this becomes the notional principal. So you will anyhow get 1.5%. That's the benefit to you. Okay. Notional principal 15 million. Indicate whether the treasurer should take long or short position. It should take short position. Whenever you expect the interest rate to go down, you should take a sell position today. If something is expected to go down, you should take a long position today if something is expected to go up. In this case, we are expecting the interest rate to go down. Take a short position today, okay, to hedge. Using the appropriate terminology, identify the type of FRA used here. For how many period we are investing? $90 days itself, I think. The FRA that expire in 90 days is based on 90-day FR LIBOR. Acha, good. See, the LIBOR given at the end of the 90 day is also for 90 days. That means we are supposed to invest for further 90 days. That's it. From this particular part, not that 90 day or not that 90 day, but we have been given with this 90 days LIBOR. That means after, at this point, this 1.25% is quoted. Understand, this 1.25% is quoted only for the further 90 days. So whosoever wants to invest or take a loan for the further 90 days can do that at this rate. But if you want to take a loan at this date for 1 year, this rate is not applicable to you. And if we want this rate to be compared with this rate, we have to take this rate. That means we will be investing at this rate, and that means we are investing for 90 days only. So what type of FRA is this? 90 days, 90 by 180 FRA? No, sir. We will have to call it in terms of months. So 90 days is 3 months and 180 days is 6 months. After 90 days, we are investing for further 90 days. We are investing for 90 days. So 0 to 90 is 3 months and 0 to 180, 90 plus 90 is 180 days. So this will be called as, understand, in the second part, 3 by 6 FRA. This means that 3 is the months from now the investment is starting, and 6 are the months from now the investment will end. The difference between these will explain the period of investment, which is again 3 months, which is equal to 90 days. So this is going to be 3 by 6. Calculate the gain or loss to the company as a consequence of entering into FRA. Can you calculate that? Yes, sir, we can calculate that. The gain or loss is 0.25%, but understand one thing. How much is the 0.25% on 15 million? Let's calculate that. 0.25%. That amount comes to 37,500, right? But don't you think this was per annum rate and this was also per annum rate? So the gain was also per annum, right, sir? Then what we should do, this 37,500 is the cash flow at after 90 days from this date. So we should discount these cash flows. we should discount the 37,500 by 90 days at the spot rate, reference rate. So how to do that? 1 plus 0.0125, am I right? Into 3 months divided by 12, or you can say 90 by 360, whatever you want to use, and then we can calculate it. So let's calculate in the third part with the help of the formula. The proper way of answering in the exam is settlement amount is nothing but notional amount. What is the formula? Please understand. In case of shorting, you will just write forward rate minus reference rate. So this is how you have to make sure that you are making a difference in the long FRA. In case of long FRA, you will keep reference rate first, but in case of short FRA, you will keep forward rate first, so that the figures are proper. Gain is positive and the loss is negative. Let's do one more thing. In here itself, I will just write down here. In case of long FRA, we will write RR minus FR, and in case of short FRA, it will be FR minus RR. Okay, remember that. Into, does the question ask us to take 365 days? No sir, so we will take 360 itself. Days till maturity, days in a year, divided by 1 plus reference rate into days till maturity, days in a year. Let's write down 15 million into 0.015 was agreed rate, 0.0125 was the reference rate, into days till maturity 90, days in a year 360. 1 plus 0.0125 reference rate always for discounting into 90 by 360. Let me calculate it once again. Right, 90 by 360, that's 9375 payable at the end, divided by 1.003125. This is going to be the settlement amount. You will always have to calculate with the help of the formula. You should 9345.79 exact amount of calculation. The same formula is being used here. So this is question number 3. Let's come to question number 4 now. This was all first question, second question, third question, and the fourth one. All the 4 depends on the forward rate agreement itself. TM FinCorp has bought 6 by 9 FRA of 100 crore. Now understand what is 6 month, and in this question I think we are buying bought. Yes, this has a lot of meaning. In this question nowhere you will find I think that we are borrower or we are the investor or whatever it is, but we are buying FRA. That means in future we want to buy money. That means we are the borrower. So bought FRA, that means long FRA. Long FRA means we are the borrower. Okay, so in this case interest rate rising will be your risk, right? Am I right? You want the interest rate to stay low if you are the borrower. TM FinCorp has bought 6 by 9 FRA. From like 6 months from now, the interest loan period will start for, let me just draw it. This is 6 month and this is 9 month. So this is 9, 6 and 0. Today we bought the FRA in the derivatives market. We have a long position, right? That means after 6 months we want to buy loan or take the loan, and we are worried about the rising interest rate and we don't want to pay a higher amount of interest in this case. That's why we are fixing the rate. After 6 months, rate is fixed by today itself in FRA. So we are going long. And this entire loan period will be only for 3 months, the difference between 9 and 6. So on 100 crore, we are taking a loan for 3 months after 6 months. For 3 months after 6 months. Okay. And the rate fixed is 5.25%. If nothing is given, that will be per annum rate. Okay, sir. Then on fixing date, understand, market, the way they have written is a little wrong, but you can consider it like this. After 6 months. I will tell you why. Because today's 9% rate was irrelevant for us in the entire scenario. If you remember this question, this today's 9% rate was irrelevant for us. So if the question has given you some reference rate, underline this word also, reference, and this is nothing but the spot rate after 6 months. And they have not given LIBOR, it's MIBOR. It's a local version of LIBOR. What is MIBOR, sir? MIBOR is nothing but Mumbai Interbank Offered Rate. And on this date, the MIBOR was 3-month MIBOR was given like this. Now I will just show you how it is presented. So on this date, in the spot market, the rates were given. So which rate is applicable for you? You have to decide. The 3 months LIBOR was 5.5%. MIBOR. 3 months rate was 5.5%. 6 months rates and 9 months rate. All the three rates are given: 5.75, 5.70 and 5.8. Now tell me, which rate is applicable to you, applicable for you? It's very simple, sir. If I have taken a 3 months FRA, 6 by 9 means I am taking a loan for 3 months only. So if I have to borrow loan in the spot market, I will go for a 3 months FRA. I don't have to do anything with 6 months FRA, 6 months spot rate and the 9 months spot rate. If I have to take the loan, I am taking it for 3 months only. So this rate is comparable with R. Because this is a 3-month rate and this is also a 3 months FRA. 3 months FRA doesn't mean this rate is for 3 months. This is a 3 months rate per annum. If you are taking a loan for 3 months, then the per annum rate is this much. So you are going to compare. This is a 3 months. Just let me just write down. This is a 3-month FRA. And you need to compare this with this. Do you understand? So all the other rates are irrelevant for you. They have just given, they have been just given for the purpose of confusing you, so that students get confused in the exam. Now what happened in the previous question was, in the very first question, I will tell you. In the very first question, when I said that the interest rate can go to 9.60%, you had no other option but to compare this with 9.30, right? But there are many rates. On every day, there are different rates given. You should know which rate is applicable to you. So in this case also, this should be 3 months rate because we wanted to borrow for 3 months. If the 6 months rate is also given, that's irrelevant to you. Okay, sir, let's go ahead. Now it's very much clear that we have to only look for 5.5%. You can clearly see that when the market is borrowing, you are long, right? When the market is buying money at 5.5%, you are buying it at 5.25%. So yes, there is a gain to you in this question. What the question is asking us, you are required to calculate profit or loss to TM FinCorp in terms of basis point. They are not asking you in terms of money, rupees, in terms of basis point, and it's very simple. Profit is 5.50 minus 5.25, reference rate minus FR rate. In terms, when you take long forward, it should be RR minus FR. When it's short, FR minus RR. That's 70. That is how many basis? 75 basis point. So this is your gain. Okay. Now what is the second part? The settlement amount. What do you think will be the settlement amount? Very easy, sir. How much is the amount of loan? 100 crore. Settlement amount. We have a formula for settlement amount. But you should know the logic as well. Settlement. What should be the formula? First, take the notional principal amount. Since you are long on FRA, you will take reference rate minus forward rate multiplied by days till maturity, or in this case months are given. So I will take months till maturity and months in a year. 1 plus reference rate into months till maturity, months in a year. 100 crore into reference rate 0.055 minus 0.0525 into 3 by 12. After 90 days, there are only 90 days left. Na? For 3 months only we are taking this. For 3 months only we are taking this loan. After 6 months, we are taking it for 3 months. Divided by 1 plus 0.055 into 3 by 12. $6,25,000 in the numerator. This is the gain to be receivable after 9 months, but it will be settled at the end of the 6 month. 1.01375. I hope you know the logic of all these things. 616,523 settlement amount. Let's just check this. Acha. Okay. They have asked us to assume 360 days in a year, and 3 months has been taken as 90 days. But in this question, they have taken it at 92 days, which is, I think, wrong. Otherwise, the question is very clear that alternatively it can also be taken as 90 days. And if you take it as 90 days, it will be 616,523. The answer, our answer is right, which is also according to the institute. So don't worry about it. I don't know why they have taken 92 days, because the months have not been given to you. So there is no point in taking 92 days. No one in the question or exam will take 92. I don't know why. Okay, so 616,523 according to 90 days will be your answer. Okay, sir. Formula is same, 100 crore, the difference between the reference rate and the spot rate. Then convert it into 3 months rate. Do you understand the logic of forward rate agreement now? Now I have a question for you. The question is, till this point, you were a hedging, okay? 5.25 was the actual rate of FRA given in the question. Now tell me one thing. Forget about the spot market position. You don't want to borrow money. You don't want to invest money. You don't have money altogether. There is no spot market. I just want to play the game. I want to make a profit. I am ready to take the risk. And I just want to enter into FRA. And FRA for 3 months is given as 5.25%. Tell me one thing. Should I buy FRA or short FRA? till this point, since we were hedger, we used to look at the position that we wanted to take in the spot market after 6 months. If we wanted to borrow money, it was a long position, and based on that we used to take a position in FRA. So unless and until you know the position in spot market, you were not able to decide the position in forward market. But that was when you were hedger and you had to do something in the spot market. But if you don't have to do anything in the market, you will not know the position on this date. Then how to make a profit and how to know that whether we have to take long position in the forward market or the short position in the forward market? Even, I'm telling you, even if we go for the arbitrage, do you really believe that 5.25% is the correct valuation of this FRA? It could have been more or less than this. And if the theoretical price of this is not equal to 5.25%, then there will be some opportunity to arbitrage or the opportunity to gain something. All in all, what I want to say is that if the question only gives you this much of the data that 3 months FRA is 5.25% and the spot rate expected in the market is this and this and this and this and this. Okay, you don't have to take the loan, you don't have to borrow the money, you don't have to you should not have sell the money in the beginning, but you can take the position in the forward rate and the spot rate simultaneously today and settle them after 6 months and make sure that you are earning. All in all, what I want to say is that the next chapter, the next topic for us is calculating the theoretical forward rate. How to calculate this rate, 5.25%. How to calculate this rate theoretically what should be the rate? We can know this, and if the theoretical rate calculated by us does not matches with this rate, then there will be an arbitrage possibility where we can earn something by taking position in both the markets. Okay, sir, we'll take a break, and in the next lecture we are going to discuss about the theoretical forward rate agreement. That means the theoretical price of forward rate agreement. See you.